Policymakers are about to enter the most challenging environment in decades. That's a warning out from a new report from Deutsche Bank. The bank says that inflation will be the defining macro story of the decade, with monetary and fiscal injections, in their words, off the charts. Let's bring in the author of that report, Jim Reed. He's Deutsche Bank's global head of credit strategy and thematic research. And Jim, you have spelled out the threat of inflation in pretty dramatic terms here, saying we are witnessing the most important shift in global macro policy since the Reagan-Volcker axis 40 years ago. What's different about inflation that we see this time around?
Yeah, well, I'm glad you brought up the Reagan-Volcker axis, because I think it's the contrast that is impressive to us. If you go back 40 years ago to when inflation was beaten, it was really beaten by a combination of Volcker being elected at the Fed to be a massive inflation hawk, and then Reagan was elected to be a big government hawk. So he had a mandate to reduce the size of government. And that worked to reduce inflation for years, if not decades. Other factors were there in the background. But contrast that with what we have today. We have a Biden administration which is admirably putting social goals at the heart of its administration, but it is spending an enormous amount, and big government is certainly back today. And at the same time, the Fed has embraced average inflation targeting, and now wants to see actual gains in key economic variables, including employment especially, rather than just a forecast of gains. So the era of the Fed leaning against any inflation is over, really. So that contrast is what really staggers us. And when you put it together, if you look at monetary and fiscal policy today, it has never been as coordinated as this, never in history. And that's why we think inflation is a big risk here. Now, I must confess that this divides opinion in the market. It divides opinion in Deutsche Bank. So not everybody agrees in the market, not everybody agrees in Deutsche Bank, but we think it's the defining topic of the next decade, and we want to kind of have a proper two-way debate on the topic.
Yeah, and obviously the two-way debate's important, but you think back to maybe some of those warnings before, and it's a lot of boy who cried wolf when you think about hawks signaling warnings on inflation. And when you look at it, also the 10-year's come down a bit now at 1.533, which is down considerably from where we were in March. When you think about that, though, we've had other guests point out that it might not be reflecting actual inflation fears, and you got to look at the break-even inflation rate here. I mean, when you look at those metrics, what does it say about where the market is in terms of figuring out which side of that debate is winning right now?
Well, if I had to characterize it, I would say that the data since the COVID pandemic came through, the inflationists have overwhelmingly won round one of the battle. Go back a year, 6 months, nobody would have imagined that inflation would be as high as it is today. So inflationists have absolutely won round one of this battle. However, the Fed, since in the last 4 to 6 weeks, have come out with a very coordinated message that inflation is transitory. And if they're proved right and inflation is transitory, they've done a spectacularly good job. I suppose the risk is that in being so coordinated in saying that inflation is transitory, if it isn't transitory, then they have a bigger about turn to make than they might have needed. But I think the fact that the Fed has been so coordinated is the reason why 10-year yields have been becalmed in the last few weeks. But remember, they started the year very badly, so they're still up a lot in 2021 so far.
Jim, one of the other points you make in terms of why the risk from inflation is elevated this time around is that you say that the policies in place, the constraints on policy, which have historically been inflation as well as debt sustainability, haven't necessarily been seen in the same prism, if you will. What does that suggest in terms of the tools that the Fed, for example, has at its disposal to try and control this? I mean, does that suggest that there are less tools in the toolbox, or how should we be looking at that policy in the context of those constraints being removed?
Yeah, well, I think just to go back to the first part of your question, really, a decade or so ago, when we came out of the financial crisis, there was a lot of concerns about inflation at the time. But if we look back with hindsight, the big problem was that we very quickly ran into the sovereign crisis in Europe, the Greek default, and Reinhardt and Rogoff came out with their seminal work about government debt going above a certain level being very detrimental, and that scared every politician and every government around the world, and we went on a fiscal austerity drive. And the reason we didn't have inflation after the financial crisis was that we had tight fiscal policy at the same time as banks were retrenching, the consumer was retrenching, and monetary policy just held the economy together. None of it really dripped into the real economy. I think what's different this time is that after the pandemic, during and after the pandemic, it looks like fiscal policy is here to stay for a lot longer, and monetary policy is very supportive of it. So that's why I think this time is different. In terms of the tools, the second part of your question, I suppose that is one of the problems we suggest in the report, that if you're tolerating higher inflation now, it's going to be very difficult to back out of that if inflation does come through above what you feel comfortable with. So, if the Fed might have to change course quite abruptly if inflation isn't transitory, and therefore that is a risk to their policy making at the moment.
Jim Reed, Deutsche Bank Global Head of Credit Strategy and Thematic Research. It's good to get your insight today. Thanks so much for your time.